Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Stocks falter. Well, it was only 2 weeks ago that I talked about how resilient the stock market had been so far this year. Now it seems there are cracks in the market facade. Investor pessimism has ramped up pretty quickly, with the American Association of Individual Investors showing less than 20% bulls versus more than 60% bears. That's actually the highest level of bearishness going all the way back to September of 2022, and it's nearly as bearish as early 2009. Now, as you might expect, if you're a regular viewer of the Investor's Edge, extreme bearishness tends to be a contrarian indicator. In fact, those prior extreme readings I just mentioned in 2009 and 2022 were great buying opportunities. Now, will this time be different? It's always hard to know when you're in the moment, but for now, we're staying cautiously optimistic and using the current market pullback as an opportunity to add to some of our favorite stocks. For this week's featured insight, asset allocation advice. The most important decision most investors make is how to allocate their assets between different types of investments. Now, assuming you invest in a diversified portfolio, your allocation between stocks and bonds will drive roughly 90% of your performance results. Yes, I understand there are other potential asset classes to consider, but keeping it simple, most investors will primarily own equity and fixed income investments of some type or another. Now, I like to tell people you should own as much equity exposure as possible, such that you never put yourself in a position to sell at an inopportune time. In other words, when the market's down. Now, the first reason you might do that is if you need the money. So if you expect to withdraw funds in the next couple of years, or if you're taking regular distributions from your portfolio, that money should be invested in money markets or other short-term fixed income securities. Now, the other reason you might sell at an inopportune time is that you panic when the market goes down. Now, this is a function of your risk tolerance. So try to imagine how you might react if your portfolio fell 20% in value. If your answer would be that you would liquidate everything to stop the bleeding, you should probably consider a smaller allocation to stocks. Looking ahead, is Goldilocks coming to town? I previously talked about the recent weakness in the stock market. Now, some of that's being driven by fear of tariff-related impacts or job losses among some government workers. Then there's also some cyclical economic softening that's bringing down corporate earnings estimates. Nevertheless, this might end up being exactly what the doctor ordered. If the current soft patch leads to lower inflationary pressures and lower interest rates, without causing a deeper downturn or a recession, we could end up with a Goldilocks scenario, where things are not too hot and not too cold, but just right. Spoiler alert, the stock market tends to love that type of environment. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.